Good morning. It's me, Kenny Polcari, your host of the party, and today is Tuesday, February 21st, 2023. And where am I today? Well, I'm at LaGuardia Airport in New York City trying to get back to Florida, to Palm Beach. But I got to tell you, JetBlue, once again, delayed flights and canceled flights yesterday. Delayed flights first thing this morning. I got the first morning flight out of LaGuardia today at 7 o'clock, just got delayed until 8:48. For what reason? I have no idea. But I got to be honest with you, I'm getting more and more frustrated with JetBlue, but that's a whole nother conversation. Let's talk about what you need to know. It was a long weekend. Monday was a holiday. Not a whole lot going on in terms of the markets because we didn't trade, although European markets and Asian markets were open and they ended up trading a little bit lower. But what's happening today and what is it that you need to know for the week ahead? So on Friday, stocks continued to thrash around, right? Trying to find direction. Are they going up? Are they going down? And what's the tone? Vladimir is out this morning blaming the West for the war on Ukraine. It is the 1-year anniversary this week of the start of that war. Joey, in a surprise visit, went to Kiev yesterday, committing $500 million more U.S. dollars to Ukraine. J.P. Morgan and Goldman Sachs are warning of further downside ahead, while Morgan Stanley is talking about the death zone. And what do we have for dinner tonight? We're going to have the lamb shank Osso Bucco. Delish. Okay, so look. Stocks closed mixed on Friday as investors, and traders, and algos continued to digest the very strong PPI report that happened on Thursday. And since there was no real macroeconomic data on Friday to consider, everyone continued to speculate on what it all means for future Fed policy, what the higher CPI and the higher PPI mean for future Fed policy. And don't forget, this week it's all about the PCE. The Dow and the Russell were the two gainers on the day, but nothing really dramatic. The Dow added 130 points, the Russell tacked on 4 points. The S&P lost 11, the tech-heavy NASDAQ gave up 70 points, and the transports gave back 75. Bond yields surged, right, as prices fell. The 3-month yield is now 4.8%, while the 6-month and 1-year T-bills have now pierced 5%. The 2 years yielding 4.6 and the 10 years at 3.83%. Short duration bonds are now offering a real challenge to stocks, and that is partly responsible for the chaotic moves. The other part is this: the algos have just taken stocks to levels that I don't think make any sense at the moment. Remember, the algos continue to think that the Fed will pause in March and then cut rates by late summer, maybe early fall, something that I do not think is possible at all. Now, on another note, think about what a 6-month and a 1-year bond yield at 5+% is doing to the investor psyche, right? It's completely guaranteed. There's no risk. You get to sleep at night versus what Morgan Stanley is calling the death zone, right? Mikey Wilson, Morgan Stanley's chief strategist there, is calling the current level of stocks the danger zone, or the death zone, I guess, right? That's correct. Mikey refers to the current level in the markets as the death zone. Now listen, the death zone is defined as a mountain altitude above a certain point where the oxygen pressure is insufficient to sustain human life for any extended period of time. Adding that investors have followed stocks to dizzying heights once again, where they know they shouldn't go and can't live for very long. Well, just a bit dramatic, no, Mikey? I mean, dizzying heights? Really, Mikey? We're not really at dizzying heights, but maybe we are. I addressed this issue yesterday when I was on the Fox Business The Claimant Countdown with Ashley Webster and Scott, the Cow Guy Shalady. You can find that on the Fox Business site. Just search for The Claimant Countdown and then search for Kenny Polcari, and yesterday's piece will come up. But we addressed the whole death zone conversation. Now, my point is are stock prices out of whack just a bit? Yeah, probably. Is the market a little bit anxious? Yup. Is it about to collapse? I don't think it's about to collapse. I think S&P 4000, which is down about 2% from here, is going to be the place that gets tested this week. And if it holds, that will be a positive. But if it fails, then I suspect we're going to test the December lows of 3750, 3800-ish, which represents a 7% decline from current levels. And remember, a 7% move up or down is within a normal band of trading, especially when the landscape is as anxious as it is right now. This week, there's a lot of economic data: manufacturing PMI, services PMI, existing home sales, the FOMC minutes from January, first revision to fourth quarter GDP, no changes expected, personal income, personal spending, and the star of the show, yep, the Fed's favored inflation guy, the PCE deflator. And after what we heard last week, You can expect this report to be the data point that everyone is going to focus on. Now, the market is expecting the PCE to show a gain of 0.5%, month over month, up from last month's 0.1. And year over year is supposed to be unchanged at 5%. Now, if you look at the core PCE data set, it's still expected to show a gain of 0.4%, up from 0.3, and the year over year number of 4.3 down from 4.4. But not so quick. Both the CPI and the PPI surprised to the upside last week, and they too are a measure of inflation. So you have to believe that the PCE, which also measures inflation, has to be stronger than the expectation. I mean, it has to be, right? If it isn't, then something smells rotten in the state of Denmark. Now, it says nothing about Denmark because I love Denmark, but it's that line spoken by Marcellus in William Shakespeare's Hamlet, Act 1, Scene 4. Look, JP Morgan is out this morning with a note today that suggests more downside and more volatility ahead, telling us that it's too early to take a recession off the table, and I agree, and that the January highs will be the highs for all of 2023. I'm not so sure I agree with that. Goldman is also out with a note, and they see the Fed hiking by another 75 basis points before they pause. Look, I've been saying it for weeks now. The Fed is not ready to pause, never mind pivot. Traders and algos have taken stocks higher. They've gotten well ahead of themselves, as so many talking heads have convinced us that not only are we not going into a recession, but we're headed for a soft landing as well, that the Fed can navigate this, that the Fed will pause and then pivot, something, again, I am not buying. It makes zero sense that the Fed would pivot in 2023. Look, we've got members of the Fed floating the idea that the terminal rate is now somewhere between 5.5% and 6%. That's up from 4.75 and 5%. And while there are some analysts and economists that disagree, there isn't one Fed member that's challenging that comment. And so my gut tells me to pay attention. Is the narrative changing? And if it is, then stocks will need to reprice lower. Look, inflation was trending lower, although the past 4 readings have been revised higher. Yet it isn't trending lower fast enough. And with the Fed easing up on the increment of each rate hike, I was afraid that inflation was going to rear its ugly head again. And that is what we saw last week. The fact is the CPI and the PPI went up because inflation has become sticky in places that won't necessarily respond until they take rates higher. So the question is, what is the rate that breaks the back of inflation? 4.75, 5, 5.25? Or is it somewhere above 5.5%? And that is what the market is considering now and trying to understand and then trying to price for. Look, with the 6-month and 1-year Treasury bills yielding more than 5%, I would expect to see short duration cash go into these assets before much of it goes into stocks, especially if the narrative about how high the terminal rate will be continues to suggest somewhere above 5.5%, because that's going to create some volatility in the markets. And if you got some money that you want to put to work, but you're not so sure, you might just park it in short-term treasuries. U.S. futures this morning are weaker on this Tuesday morning. Dow futures down 250, the S&P down 40, the Nasdaq down 150, and the Russell off 20 points. Wednesday brings us the FOMC minutes from the January meeting. Will they reveal anything really new or just leave it open to interpretation? Are we in for a hard landing or a soft landing or in fact no landing? Now, no landing is becoming the latest narrative, and it suggests that the economy does not slow down and inflation remains stubbornly high, potentially going higher. And this makes no sense to me. Why? Because the economy will slow down if the Fed takes rates high enough. And if their goal is to slow it down, then you can expect them to take rates high enough and then keep them there for an extended period of time. In fact, New York's Johnny Williams, Fed President Johnny Williams, told you last week that he said he continues to see rates will move up, and when they get to whatever the terminal neutral rate is, he expects them to keep them there for a few years, not months, but years. And that flies in the face of all those calling for a rate cut this year. and why I'm not buying that rate cut commentary. Look, eco data today includes manufacturing and services PMIs, and remember, both are expected to be in contractionary territory, which is sub 50. And services PMI is a very important number since we are a services economy. We're also going to get existing home sales, and they're expected to be up 2%, which is interesting. Many now suggesting that a declining mortgage rate market is key, right? Current 30-year conforming rates are about 6.2%, down from 7% only 2 months ago, which is an 11% decline. But it's up from 3.5% 1 year ago, which is an 80% increase in the cost to carry, right? And they are likely to move up in the weeks ahead as the Fed raises rates and the 10-year pushes higher, because, you know, the 30-year money is priced off the 10-year T-bone. Look, oil's under a bit of pressure. Think the stronger dollar on the back of the higher rates, right? This morning oil's trading at $76.30, not a disaster, but it's getting closer to that level that forces the Saudis to make noise about cutting production to help support oil prices. Recall, $80 a barrel is their preferred price. The dollar index is up 12 cents at 104, and that's putting pressure on the whole commodity complex. Expect the dollar to continue to push higher as rates move up. European markets were lower yesterday, right? And they're lower again this morning. Markets across the whole region are down about 0.5%. The UK PMI today came in, it was a bit stronger than expected, but earnings remain mixed. Vlad is giving a State of the Union type speech in Moscow this morning, and he's blaming the expansion of NATO along with new European anti-defense systems for provoking Russia, forcing him to stop the war that the West began. Remember, Friday marks the 1-year anniversary of the Russian invasion. Joey made a surprise visit to Kiev yesterday and promised even more money for Ukraine. $500 million, in fact, that's going to go to pay pensions for Ukrainians and provide more weaponry for Zelensky. All this to reaffirm our unwavering and unflagging commitment to Ukraine's democracy, sovereignty, and territorial integrity, right? I just wish Joey would do the same here in America. Joey's now giving a rebuttal-type speech in Poland this morning, so expect lots of chatter about what this all means, not only for the geopolitical narrative, but also for the markets. The S&P lost 11 points on Friday to end the day at 4,079 after trading as low as 4,047, a level where it found support in early February. Remember, S&P 4,000 is the key level to watch. The S&P pierced it on March 29th on the way up and has pushed higher ever since. And then on February 2nd, we saw the golden cross. That's when the short-term trend line, the 50-day moving average, crosses up and through the long-term trend line, the 200-day moving average, which is technically a bullish signal that suggests higher prices ahead, which is why I say the S&P 4000 is key. Okay, so what do we have for dinner tonight? We're having the lamb shank Osso Bucco, right? Now look, I love Osso Bucco, and while Osso Bucco is usually made with veal shanks, here's a recipe that features lamb shanks, right? And it is good, right? So I hope you enjoy it. You really make it the same way, except you're just using lamb shanks. So for this, you're going to need the lamb shanks. You need flour, salt and pepper, onion, garlic cloves, carrots, parsnips, rosemary, thyme, tomato paste, and your favorite red wine and beef stock. Now, I don't use parsnips in my veal Osso Bucco, but you do use it in the lamb shank Osso Bucco. Now, in a large Dutch oven pot or a cast iron type of vehicle, you're going to add a little bit of oil, let it get hot. You're going to take your lamb shanks, you're going to coat them lightly in salt and pepper, seasoned flour, and then add them to the pot and brown on all sides, right? Once they're all browned, remove them and set them aside. Now, back in that same pot, you're going to add 1 large onion, chopped onion. You're going to add, 10 to 12 cloves of chopped garlic. You need 4 peeled and cut carrots and the parsnips. I like parsnips because they add a little bit of sweetness to this lamb dish. And about 1 teaspoon each of finely chopped rosemary, thyme, a half a can of tomato paste, salt and pepper. Let it come together over medium heat for about 5 minutes. Mix it all together. It should be smelling really very fragrant and pretty good by now. Now you're going to deglaze the pot with 1/2 to 3/4 of a bottle of your favorite red wine. You don't have to use anything fancy. A nice Cabernet. Put it in there, scrape up all the good stuff on the bottom of the pan. Add the carrots and the parsnips halfway through the cooking process here if you want them to remain a little bit crunchier. If you want, just add them whenever you want. You're going to get nice and soft anyway. But I found that it's the lamb and the sauce that are really the stars of this dish, and the root veggies are there to add flavors to it, as they always are. But focus on the whole dish, right? Now, once that's done, you're going to add the shanks back to the pot, nestle them nicely and all that goodness, and add some good beef stock now, covering the lamb, just covering the lamb, not drowning it, but just right to the top and cover it. Preset your oven to 325 degrees and put the covered pot in the oven for at least 4 hours. The longer you leave it in there, the better it's going to cook. It's just going to fall off the bone, right? Give it a stir every now and again. Watch to see how the meat is separating from the bone, as this will tell you how the cooking is going. I like mine literally falling off the bone, so I've left it in for more than 4 hours. And if the shanks are big, you'd leave it in, close to 5 hours anyway. Now, when it's ready, remove it from the oven. Let it sit for about 20 minutes covered to allow the flavors all to come together, right? There are lots of things that you can serve this deliciousness over to suck up all the sauce, but in this case, I prefer a creamy polenta, right? So you're going to make the polenta, put it on the bottom of the dish, and then take the lamb shank, put it on top of the polenta, and then take a ladle and put some of that juice all over it. My God, it is so delicious. Now look, it's raining here in New York. It's kind of a cloudy day. I'm trying to get out of here and get back to sunny Florida, but until tomorrow, take good care.